Welcome back to Making Money Matter, ladies and gentlemen. I'm your host, Kerry Stevenson, back at IMARC in the on-air booth. Managed to snaffle Sean Russell. He is the founder and managing director of Noah's Rule, based here in Sydney. What Sean doesn't know about gold, silver, precious metals, hedging, that he has spent a number of decades in is not worth talking about. And those of you that were at the Australian Gold Conference last week would know that he ran a very lively discussion on what's going on. But why I grabbed Sean right now at IMARC is because some of you are freaking out a little bit about the fact that the headlines are saying it's all over for gold because the gold price has pulled back a little bit, as has silver. Silver down, I think, about 10% and gold about 5%. Now, I just want to get your take on this, Sean, and, talk to my audience. Did we hit a high? Are we going into a cyclical low, or is it, as I see it, it's a good little breather?
Oh, look, I think I said last week at your conference that we don't have a significant correction that makes you feel uncomfortable in the next couple of months. It's probably not healthy for the market. If it has kept going the way it was going, you don't want a market to go parabolic, because when it ends, the market's dead for a very long time.
Right.
So let's take a step back for a minute. And I think 2 years ago at your conference, when someone in the panel session said, what's happening to the gold price, and make predictions, people feel need to make predictions. And I said, sell anything you own, use the money to buy gold. And I feel quite comfortable that in a couple of years' time from now, you could buy more of that thing back with the gold you own. So what do I mean? Gold is going to outperform most things. And in particular, talked about gold outperforming equities. I talk about the Dow Gold ratio all the time. Pierre Lassonde popularized that, but really that gold was outperforming equities in Australia, was outperforming. So the long-term trend for gold is it's outperforming general equities. Therefore, you should have some in your portfolio. Another question then, whether you want to own gold or gold equities. We won't get into that today. So that's the big picture theme, and that hasn't changed.
Great.
Right?
Yep.
So gold is in a. So if this is a mountaineering exercise and we're climbing to the top of Mount Gold, 2 weeks ago or 3 weeks ago, we wrote to our clients and we said, we are in the kill zone. We are at the altitudes where climbers get hypoxic. Most people on Mount Everest die above a certain altitude because they run out of oxygen.
Yeah.
And the question was, does the market have enough oxygen here? And our kind of suggestion was, and this is only 2 weeks ago, we said, we're in the kill zone. We're not sure how long the market can survive or stay in the kill zone. But what does that mean? It means that if you get hypoxia, if you're climbing a mountain, people know you have to go back down to assimilate, to then go back up again. You need to get your body time to adjust. Markets are the same. So we said we think this is a false summit. We're getting to this and it's like foggy. We don't, like we're climbing a mountain into fog. We don't know where the peak is.
Yep.
So we're at a false summit. So there's a reasonable chance we're going to go over the summit, come down the other side, and then come back. So the big question is, and I posed this for the people last week at your conference, how much of a decline can you afford to tolerate, and how long can you afford to wait? And last week, I said that in previous kill zones that were as extreme as we've seen, US dollar gold 2006, 2008, 2011, and 2020, 4 highs that had similarly kind of stretched levels. The shortest one was 16 months to make a new high.
Really?
And it retraced as much as 20%. Now that's the other.
For some people that can be very painful.
Now, and if you were queued up at ABC 2 days ago buying, So, but again, it's looking at everything else. The longer path is right, but I don't think and probably that's the FOMO of that queue, which got so much media. I have people from around the world telling me what's going on in Australia.
Yeah.
Right? Normally, people are queuing up to sell gold, not queuing up to buy it. But anyway, so that sort of tells you about where we're at. But I think all the way through the 2000 to 2011 move that was substantial, right? Very substantial. We had those sell-offs. We had those corrections, went back down under the 200-day, or we had that, 10, 11% wasn't unusual. Now, the problem now is if you have a $6,500 price, 10% of that, that's a lot of money.
Yeah.
20% of that, that's $1,300. So, and the gold price wasn't $1,300 until about 2008 or 9, right? So we're having moves now. Like I've lived in my working life the gold price hasn't been as big as the range we had in the last 2 days. Right? So the
Right,
gold
'cause
price
the bigger the-
changed in
yeah,
price.
yeah.
So, but it will always be that percentage moves will be the thing, not dollar moves. So as an investor, that's a real issue, right? So you don't go, oh, $100, I can wear it for $200. No, you have to be willing to wear it for 10 or 20%. If you don't have that kind of risk tolerance at the moment, you probably need to be waiting to buy cheap or doing it a different way. I mean, that's really the issue.
When you say doing it in a different way, what do you mean by that?
Well, smaller position size,
Right.
instead of buying 3 ounces, buy 1 ounce, like you've got to have to manage your risk in terms of the dollar value that you're willing to lose, or you've just got to, you've got to be willing to put it aside and, be willing to work through that. You're
Yeah.
buying it. I use the example of whether I'm buying for me or I'm buying for my granddaughter Clementine, and my 21-year
name.
strategy to give her, I said at the conference in the Gold Coast, I started off in her first year buying silver, not gold, because the gold silver ratio was so appealing at around 100 to 1. If I'm, instead of buying a 1 ounce of gold for calendar 2025, I'm going to buy 100 ounces of silver.
Nice.
And at some point, maybe the gold silver ratio goes back to 60. I take those 60 ounces, I buy an ounce of gold, I've got 40 ounces gold left over for grandpa, or I give Clementine more. But it's that relative thing. And I think that's where we're at the moment. Silver ran very hard. Everything ran very hard.
Yeah.
And on our scoring system that our clients enjoy access to, it goes from -6 to +6. Silver was +6 at daily and a weekly time zone the last couple of weeks. Gold is +6. That's kill zone. That's where
kill zone material.
you're just into that period where you go, how long can the market sustain this? And will it run out of oxygen? And I think in the last couple of days, we're there. Now, the interesting thing is, even at where we are today, we're still in the kill zone. We're still above the kind of height that the market can naturally stay at without potentially needing to come back and acclimatize.
And I think it's what I'd like to understand as well is the fundamentals haven't changed.
No, fundamentals haven't changed.
And
we're still on a mountain climbing expedition, and we're still going to go higher. And it's my personal belief and my investment strategy.
But we're just out of oxygen.
Well, the market's run ahead of itself.
Right. Yeah.
It's a bit like you go on a long distance run, and you'll see the one person that runs much faster than you at the beginning, and you're so tempted to chase that person.
Hare and the tortoise.
But yes, but that person, you chase them, you're going to get so worn out, you can't jog at all. You've got to pace yourself.
Yeah.
This is 100-kilometer, 500-kilometer march that we're going on. You don't want to burn out in the first 50 Ks. Now, I got very aggressively into gold 3 years ago. I've trimmed, into this craziness when people are queuing, I've trimmed. I sold my silver. I reduced the amount of gold equities that I have, and I put some cash aside waiting for this retracement. I can afford to do that because I'm starting from a lower base.
Yep.
And I'm very patient. I have a longer term strategy, and I have very clear ideas about the signs, I think, that will tell us that we're at the top. And one of them will be that the gold silver ratio will be a lot lower than it is today.
Yep.
And the other will be, most important one for me, everyone who's ever seen me speak publicly, the Dow gold ratio, or the ratio of equities to gold. We need to see gold to be expensive relative to equities, that you look at your ounce of gold and you go, how many CBA shares can I buy for that? How many units?
That's
of the
when
Dow
you
Jones?
rotate out.
And that's when you rotate out. And that's what Pierre Lassonde was trying to popularise when he came to Australia in the late 90s. It's 35 to 1, people. Be bullish on gold, not bearish.
Okay.
The year I finished school, it was 1 to 1.
Really?
Yes, 1 to 1. And
Showing his age, ladies and gentlemen.
I am. But I believe, I've said all the time, if I'm careful crossing the road and look after myself, that before I depart this mortal coil, I will see the Dow gold ratio somewhere close to 1 to 1. I probably won't get greedy. If it gets to 2 to 1, that'll probably be carried.
Okay.
But and at the moment it's at 10 to 1.
Yep.
But
Yep.
I started really rabbiting on about this at your conferences. It was at 16 to 1, and saying if it goes below 16 to 1, that will set alarm bells off all over the world with generalist investors who hate gold.
Yep.
But if they see gold outperforming equities, they feel the need to buy some. And I believe that's what's driving gold at the moment. It's those people who, they're not gold bulls, they're not gold bugs. They don't even like gold.
They don't like gold, but they feel like they have
actually
to have
hate
some.
it.
Yes.
But they feel they
Yeah.
have to own it because it's
Yeah.
outperforming what they understand. And when you've got equities and gold both racing, that particularly concerns me that maybe we're more like 2008, where people are racing to buy gold as insurance because they're worried about a very significant correction in the broader equity markets.
And that could be coming.
And you shouldn't be surprised that did happen, given
it's very frothy
where they are, right?
Yeah, very frothy. All right, let's finish it up. Talk to my audience. You know that I'm that gold lady.
Yes.
Also that silver lady. I think I'm hedging my bets today, as you can see with my jacket. But give us a couple of things that they should be doing now. And I think one of them is, like, I guess it's the psychology of what they could and should be doing at the moment. And by the way, ladies and gentlemen, not financial advice. Sean does not know your individual circumstances. So the best thing you can do is potentially just hold back a little bit, but also don't freak out about corrections, because that's what happens. These are markets. But what would you say that they should be looking to do at the moment?
Well, what I propose to do for myself is to let this market settle down.
Yeah.
I don't feel compelled to participate at these levels. I have things I'm happy with. I have things I'm going to hold. I have taken profits and cashed up, and I'm looking to where I would redeploy. Now, if we saw the market go to new highs in gold and silver in the next couple of weeks, I might put a little bit of that money back in, because I might think it's going. But really, I think realistically, I want to give it time. I want to give 6 months to kind of really try and sit on my hands for the next 3 to 6 months and just see where things settle down. My expectation is we're going to sort of trade sideways with the dips. And I want to buy when all the newspaper are telling us it's over.
Yeah.
You know, I sold my silver really this week because of the Qs at ABC.
Wow.
I sold the silver.
Interesting.
I converted all the gold I had on the ETF to silver in April because the ratio was 100 to 1. And then I just looked at this and I went like, oh my God, all this queuing up. Like, is this just a external thing of that? Take some money, put it on the sideline, and just be a bit patient. You know, it's like rest. You know,
take a rest, take a break.
Rest.
And it's
don't panic.
And it's what I've often said to all of you out there. Don't sell your house and your children and go all in. Have a diversified portfolio, because when one's going up, the other one might be going down, but you've got to make sure that you've got diversified, but also know your own risk profile, and also make sure that you understand your timeline. You know, I
think that's a really good point, because it depends where the money's coming from that you're deploying in gold as well.
Yeah.
Because really, again, like 5 to 10, 15% of your total portfolio in gold is really, or gold and silver, is really all you need, you know, in a balanced portfolio, property and all that you discussed the other day.
Yeah.
So, but you know, if you've just sold an investment property and the idea you convert something out of gold for the same time zone you put in your investment property, or you've been long CBA for a very long time and you feel like it's expensive to convert some CBA shares into gold, that's very different than taking the cash out of your savings account and going all in gold right now while we're in this kind of kill zone. Because let me tell you, CBA is also in the kill zone. You know, like, so, you know, converting from one to the other is less of an issue, if you know what I mean. You know, CBA is also quite frothy. Yeah. So selling one frothy asset for a less frothy asset, that's a lot easier than taking your hard-earned money, and particularly if taking too much of it and putting it right now is probably the biggest thing.
And also, don't forget what I always say is cash is not your friend in the long term, because inflation will eat it away. So just be careful, get educated, understand the market, follow Sean. Follow what Sean's doing. How can they follow you on X?
No, not really.
How can they follow you?
LinkedIn occasionally. I'm posting about what we do for work, but really these kind of things we talk about, other than your conferences and conferences like that, it's everything else is really just goes to our clients.
Okay. And if somebody wants to be a client,
give us a call.
Noah's rule. Noah's rule.
It's really at institutional.
It's more insto, not retail.
Advice. So just,
but I love your what's the tagline that you use?
Predicting rain doesn't count, building arcs does. And certainly, if you want to understand more about what I've just been rabbiting on about, every presentation I've ever done, Kerry kindly had me at her conferences and things like, they're all on our website. And our last quarterly update for clients, where we do talk about exactly what we talk to clients about on all the markets we cover for clients. That's all there on the website, free. You're welcome to go and have a look at that.
Okay, so go noahsrule.com.
noahsrule.com.au.
All right, ladies and gentlemen, please thank Sean. I know we're not live, but I'd like to say thanks, Sean. Really appreciate it.
Thank you. Lovely to see you, Kerry.
Good to see you.
Bye.